Here's the brutal truth that will save your trading account. 92% of retail traders lose money, not because they pick terrible stocks, but because they cannot sit still for 60 minutes. You're probably one of them. You think trading means action. Buying, selling, moving, doing something every few minutes. You treat your screen like a slot machine that must be pulled constantly. You believe that productivity requires movement, that being a trader means trading. But that feeling is expensive. That feeling costs you $500 every time you indulge it. Let me paint you the real picture. Somewhere right now, a professional trader is sitting at their desk, drinking coffee. They've been watching the same stock for 47 minutes. They haven't clicked a single button. They haven't moved their mouse. They're just watching, waiting, breathing. In 13 minutes, they'll make one trade and walk away with $500. 1 hour of their time. One trade. $500. You, on the other hand, made 4 trades in the first 30 minutes of the session. You're down $340. You're frustrated. You're telling yourself the market is rigged or that you need a better strategy. But the real problem is simpler and more painful. You can't wait. In trading, activity is not the same as progress. For most traders, activity is the tax they pay for their own lack of patience. Amateurs chase action. Professionals chase conditions. Same market, same chart, same opportunity. One trader walks away with $500 in 60 minutes. The other bleeds $500 over 6 hours and 40 trades. The difference isn't skill, intelligence, or luck. It's the ability to wait like a sniper in the tall grass, completely motionless, until the target walks into the crosshairs. Let me walk you through this day minute by minute. It's 9:15 a.m. You're at your desk. Coffee next to you. Screen's on. You've done something most traders never bother to do. Preparation. You're not just scrolling for what's moving. You've already chosen your universe for the day, studied the charts, identified the levels that matter. One stock stands out. It's been consolidating for 3 days between $46.50 and $47. Yesterday it tested $47.15 twice and got rejected both times. Volume has been declining, which tells you the sellers are getting exhausted. You've identified your pivotal point, that psychological barrier where the line of least resistance will be decided. For this example, let's call it $47.20. Above that price, the path shifts upward. Below it, the stock remains trapped. The bell rings at 9:30 a.m. The first 5 minutes are chaos. Wide spreads, random spikes, emotional orders from people who plan nothing. The stock opens around $46.90. It pushes to $47.05. Drops to $46.82. Climbs again to $47.10. You feel your pulse tick up. It's moving. You think, if it gets close enough to $47.20, I'll just get in. That phrase, close enough, has probably cost more traders more money than any bad earnings report or surprise headline. Amateurs live on close enough. They blur their own rules the moment the market puts pressure on their patience. Professionals see that urge for what it really is, a lack of discipline dressed up as flexibility. The professional's phrase is different. If it's not my exact edge, it's not my trade. So you wait. 9:45 a.m. The stock is still chopping between $46.84 and $47.10. You watch your brain start bargaining. Maybe $47.10 is good enough, it's only 10 cents off. If I wait for the exact level, I might miss it. It looks strong. Just get in and see what happens. That last sentence is the amateur's true battle cry. Let's see what happens. No plan. No edge. Just hope. 10:00 a.m. 30 minutes. No trades. No P&L. Just a flat line. Part of you feels like you're behind for the day. Your hands are hovering over the keyboard. You're thinking about all the other stocks you could be trading right now. You're thinking about the money you're not making while you sit here doing nothing. This is the kill zone. This is where 92% of traders crack. They can't handle the boredom. They can't handle the uncertainty. So they take a scalp here, a mean reversion there. They buy a different stock that's already broken out because at least that feels like trading. Small losses. Death by 1,000 cuts. Emotional capital drained. By the time the real setup arrives, the one they were actually waiting for, They're either revenge trading to get back to break even, or they're paralyzed by fear because they've already lost money on 3 bad trades. Meanwhile, you're still watching. 10:15 am. 10:30 am. The stock continues to flirt with your level, but never commits. At 10:18, it finally tags $47.20, pushes through to $47.24, then fades back to $46.98. If you had jumped early, you'd be underwater now, stressed, second-guessing. Instead, because you waited for more than just a touch, you're still flat. Observing. Calm. Most traders by now are either overtrading this chop or they've given up entirely. They'll tell themselves later, there was nothing to do on that stock. But the truth is, they couldn't stay with it long enough to see the real opportunity. Then, at 10:51 am, everything shifts. Volume expands. You see it in the time and sales, the tape. Orders are getting bigger. The offers at $47.20, which were thick and heavy all morning, suddenly start disappearing. Someone is lifting them. Not small retail orders, but big blocks. 5,000 shares, 10,000 shares. Real money. Institutional money. Smart money. Price surges cleanly through $47.20 to $47.35 in less than 2 minutes. Volume jumps to 2.5 times the recent average. The tape shows one-sided action. Bids chasing. Offers lifting. Every seller who steps in front of this move gets run over immediately. This isn't noise. This is real. You get your confirmation. Because you waited, you're entering from a position of strength, not fear. You're fresh. You're calm. You have 0 open positions and your mind is clear because you didn't waste your energy fighting the chop. You enter at $47.38 with your planned position size. Your stop is already set, giving the trade room to breathe but protecting you if the thesis is wrong. You're not hoping or praying or guessing. You're executing a plan built when your mind was calm. Within 1 hour, you're up $500, not because you were brilliant, but because you were absent from all the trades you shouldn't have taken. That's the first revelation. The $500 didn't come from the trade. It came from the waiting before the trade. It came from the discipline to let 81 minutes pass without doing anything when your brain was screaming at you to act. Waiting is not the absence of action. Waiting is a position. It's an active, aggressive stance. It's the refusal to engage with mediocrity. When you sit in cash, you're protecting your capital for the exact moment the odds tilt overwhelmingly in your favor. The amateur looks at the chart and sees a playground. The professional looks at the chart and sees a battlefield where capital is ammunition. You don't fire at shadows. You don't fire at noise. You wait for the target to stand up and present itself clearly. But knowing you need to wait is one thing. Knowing exactly when to stop waiting and strike is another. You can't just wait forever. You need a trigger. You need a green light. In the next chapter, I'll show you the exact 3-signal framework that tells you when sitting becomes striking. The framework that separates patient waiting from passive hoping. So how do you know when patience ends and execution begins? That line is not a feeling. It is not intuition. It is not the growing anxiety in your chest telling you to do something, anything, before you miss the move. That line is confirmation. Professionals do not guess. They do not rely on gut feelings or hope or the vague sense that something looks ready. They wait for the market to send 3 unmistakable signals before committing a single dollar. Think of these signals as tumblers in a safe. Get 2 out of 3 right, and the safe stays locked. Try to force it with incomplete information, and you break the lock. You need all 3 to open the door to low-risk profit. Miss even 1, and you are not trading with an edge. You are gambling with your rent money. These 3 signals are not suggestions. They are not guidelines you can bend when you are feeling confident or impatient. They are the filter that separates high-probability setups from expensive lessons. Signal 1 is price holding above the pivotal point. This is non-negotiable. When our stock breaks $47.20, it is not enough for it to touch $47.25 for 30 seconds and then fade. It must prove it can live there. It must stay above $47.20 for at least 30 minutes. Not 20. Not 29. 30. Why this precision? Because false breakouts are like sparks. They flash, they look exciting, and then they die almost immediately. Real breakouts behave differently. They break, they pause, they consolidate, and they hold. Think about what a breakout really means. For days or weeks, sellers have been defending that level. They have been standing there saying, "We are not letting price go higher." Then suddenly, those sellers disappear or get overwhelmed. Price pushes through. But here is the critical question. Did the sellers actually give up? Or are they just reloading? Picture two traders watching the same chart. The amateur buys the breakout candle at $47.25 the second it pops. Their heart is racing. They feel smart, early, aggressive. What happens next? The stock touches $47.32, then fades back to $47.05. The sellers were not done. They were just waiting. The amateur is now underwater, stressed, watching their P&L turn red. They either take a quick loss or hold and hope, which is even worse. The professional sees the same breakout and does nothing. They watch. They wait to see if the stock can defend new territory at $47.15 or higher. Can it hold the ground it just took? If price breaks through $47.20 and immediately collapses back to $46.90, the message is clear. That was not a real breakout. It was a trap. But if price holds $47.15 or $47.20 for 30 minutes, consolidating and building energy, the message is different. The sellers tried to push back and failed. Now you have confirmation. That is signal 1, price above the pivot, defended, not just touched. Signal 2 is volume remaining elevated and expanding. Without it, every breakout is suspect. Breakouts without sustained volume are mirages in the desert. They look like water from far away, but when you get closer, they vanish. What you want is proof that real money is involved, not random retail orders, not a handful of emotional buyers chasing a headline. You want institutions, funds, serious size, the kind of players who do not flip for 10 cents and leave. They commit. They build positions. They create trends. Volume tells you who is in the trade. When a stock breaks out on light volume, it is usually retail traders buying because they saw a green candle. But retail money is dumb money. It panics easily. It sells at the first sign of trouble. Institutions, on the other hand, move size. When they are buying, volume expands and stays elevated. They cannot hide their footprints. Here is how you read it. After price breaks above $47.20, you do not just stare at candles. You look at the tape. Are shares trading in bigger clusters than before? Instead of 100 shares, are you seeing 1,000, 2,000, 5,000 at a clip? Are bid sizes growing? When a seller appears with a decent-sized block, does the market absorb it instantly and push higher, or does price stall and sag? You also check your volume bars. If normal 1-minute volume is 20,000 shares, and you are suddenly seeing 35 or 40,000 consistently for the next 15 to 20 minutes, that is institutional participation. Volume is elevated at 1.5 to 2 times normal, and staying that way. That tells you other traders, bigger than you, agree with your thesis. Now flip it. Imagine the breakout happens, volume spikes hard for 3 minutes, and then falls right back to normal. Price hangs above $47.20 for a bit, but starts to drift sideways with shrinking volume. That is the market whispering, "We are not that interested." The smart money just walked away. Only the late retail crowd is left, passing shares back and forth. Professionals see that and step aside. Amateurs see a bargain pullback and buy right before the move fails completely. Signal 3 is the broader market cooperating. This is the signal most traders completely ignore, and it kills them. You can have the cleanest breakout on the cleanest stock with the best story, but if the S&P 500 is tanking, or sector rotation is working against you, your stock is swimming against a riptide. Even strong swimmers drown in strong currents. Professionals respect the tide. Amateurs fight it, and then blame manipulation when they get pulled under. Before every entry, the professional glances at 3 things: the index, the sector, and overall market internals. Is the S&P 500 flat to positive, or is it down sharply? Is your stock sector showing strength or weakness? Are advancing stocks outnumbering declining stocks? Or is the market bleeding across the board? These questions take 10 seconds to answer, but they can save you from trades that were doomed before you clicked buy. Imagine your stock breaks $47.20 beautifully. It holds for 30 minutes. Volume is a healthy 2x normal. Looks perfect. But at the same time, the overall market has just shifted. The S&P has rolled over from green to red and is accelerating lower. The tech sector is down 1% in the last 15 minutes. Funds are not adding risk, they are pulling it off the table. In that scenario, your breakout is standing in front of a freight train. It might pop a little higher, but the odds of smooth follow-through are dramatically reduced. A professional sees that and says, conditions are not aligned. I pass. The amateur says, this one is strong, it will ignore the market. Maybe it does. Most of the time, it does not. Now watch how these three signals work together in real time. It is 10:15 am. Our stock breaks through 47.20 cents and pushes to $47.35. Volume spikes to twice the recent average. Your heart rate ticks up. This looks like the move. The amateur is already in. They bought at $47.25, and they are feeling smart as the stock hits $47.35. But you are not moving yet. You are watching. By 10:25, the stock has faded back to $47.18. The amateur is now underwater, sweating. They are thinking about cutting the loss, but you are still watching. Price bounces back to $47.28, then $47.22, then $47.30. It is testing the pivotal point, trying to decide if it can hold. By 10:35, the stock is sitting at $47.24. Volume has dropped from the initial spike, but it is still running at 1.6 times normal, not collapsing. Steady. You check the S&P 500. It is up 0.3%, flat to slightly positive. No headwinds. You check the sector, also showing relative strength. Market internals look healthy. By 10:45, the stock is still holding $47.15. 30 minutes have passed since the initial breakout. Signal 1 is confirmed. Volume is steady at 1. 8 times normal. Every push higher is backed by stronger volume than every little dip. Signal 2 is confirmed. The market is cooperating. Signal 3 is confirmed. All three lights are green. Now and only now does patience transform into power. You enter at $47.30 with 400 shares. Your stop sits at $46.70, giving the trade room to breathe, but protecting you if the thesis is wrong. Risk per share, 60 cents. Total risk, $240. Your target is 2R, or roughly $480 profit. The math is clean. The plan is clear. There is no guessing. Because you waited for confirmation, the trade works quickly. The consolidation period built up energy like a coiled spring. By 10:55, the stock is at $47.65. By 11:05, it is at $48.10. By 11:15, exactly 1 hour after the initial breakout, the stock hits $48.50. You exit with $480 profit. One trade. 1 hour. No stress, no guessing, no prayer trading. The amateur who bought at $47.25 during the initial breakout, they panicked when the stock faded to $47.18 at 10:25. They sold at $47.12, taking a 13-cent loss. Then they watched the stock rally without them, which hurt even more than the loss. They either chased it back at $47.80, buying high again, or they sat paralyzed, unable to re-enter because their confidence was shattered. The professional waited 45 minutes. They entered with complete confidence because all three signals aligned. They extracted the full move because they had no emotional baggage weighing them down. Same stock. Same opportunity. Opposite outcomes. Professionals win not because they have magic indicators, but because they demand all three confirmations before they act. Amateurs settle for 1 out of 3 and call it conviction. In the next chapter, you will discover why position size is the secret multiplier that turns patience and confirmation into actual bankable profit, and why most traders size themselves into failure before the trade even begins. Here's the paradox that will change your trading forever. The smaller your position, the longer you can wait. The larger your position, the faster you will panic. Position size isn't just about risk management. It's about emotional management. It's the volume knob for your fear And since fear is the enemy of patience, position size determines whether you can actually hold a trade long enough to make money. Most traders think position sizing is boring mathematics found in the back of a textbook. They're wrong. Position size is psychology disguised as arithmetic. If you find yourself selling winners too early, cutting trades the moment they tick against you, or staring at your screen every 30 seconds, don't blame your willpower. Blame your position size. You're trading so big that your nervous system perceives every fluctuation as a threat to your survival. Let me show you the math with real numbers so you can feel the difference in your bones. You have a $10,000 account. You spot our setup at $47.20. All three confirmation signals have aligned. You're confident. This looks like the trade you've been waiting for all morning. Now comes the critical decision that will determine whether you make money or get shaken out by your own fear. How many shares do you buy? The amateur thinks like this: I'm confident in this trade. I've been patient. I want to make real money. If this thing runs $1, I want that to mean something. So they decide to risk 2.5% of their capital, $250. With their stop at $46.70, their risk per share is 50 cents. That means they can buy exactly 500 shares. The math is simple. $250 divided by 50 cents equals 500 shares. They enter at $47.30 with 500 shares. It feels powerful. They have serious skin in the game. They're a real trader now. Then, 3 minutes later, the stock does what stocks do. It breathes. It dips to $47.10, just a normal 20-cent pullback. Nothing unusual. But watch what happens in their brain. Every 5-cent move against them costs $25. At $47.10, they're down $100 on paper. Their $10,000 account now shows not as $900. Their heart rate spikes. Their palms get damp. They stop looking at the chart structure and start staring at their profit and loss. They're not trading the stock anymore. They're trading their P&L. The mental math begins. If it goes to $47, I'm down $150. If it hits my stop at $46.70, I lose the full $250. Suddenly, the trade doesn't feel confident anymore. It feels dangerous. Fear has hijacked their decision-making process. They start negotiating with themselves. Maybe I should cut it here and save the rest. It feels heavy. Better to lose $100 than $250. The stock is still well above their stop loss. The setup is still valid. But because they're holding 500 shares, the pain of normal volatility is too intense for their mind to handle. They sell at $47.05 to stop the bleeding. 10 minutes later, the stock rallies to $48.50. They would have made $600. Instead, they lost $125 and a massive amount of emotional capital. They were right about direction, but wrong about size, so they lost. Now compare this to professional sizing. Same $10,000 account. Same setup. Same entry at $47.30. But this time, you follow the golden rule of longevity. You never risk more than 1% of your account on a single trade. Your risk budget is $100. With a 50-cent stop, $100 of risk allows you to buy exactly 200 shares. The position feels smaller. Part of you wants to add more because you're so sure this trade will work. But you don't. You stick to the plan. 200 shares, 1% risk. The stock dips to $47.10, the same 20-cent pullback. But now, instead of being down $100, you're down $40. Your account reads $9,960. You barely feel it. It registers as noise, not danger. Every 5-cent move costs you $10 instead of $25. Your heart rate stays normal. You can breathe. You can think. You can wait. Because the dollar amount is manageable, your logical brain stays in control. You're not staring at your P&L. You're looking at the chart, noticing that volume is drying up on the pullback, which is actually a bullish sign. You know your stop is at $46.70, and until price hits that level, the trade is active. You're not negotiating with yourself because the pain isn't loud enough to force a negotiation. When the stock rallies to $48.50, you make $240. Clean profit. No emotional scars. The amateurs sized for a $600 win and lost $125. The professional sized for a $240 win and kept the full $240. Same trade, opposite outcomes. The only difference was position size. This is what Jesse Livermore understood 100 years ago. He sized his positions so he could sleep at night. He never risked more than 1 to 2% of his capital on any single trade, regardless of how confident he felt. Why? Because confidence without discipline is arrogance, and the market kills arrogant traders without ceremony. Livermore knew the goal wasn't to hit a home run on one trade. The goal was to stay in the game long enough to catch the big moves when they compounded over time. Oversized positions destroy that longevity. One bad trade with 5% risk can ruin your psychology for weeks. 3 bad trades in a row with that size and you're down 15% trading scared, second-guessing every decision. But if you risk 1% per trade, you can lose 10 times in a row and still have 90% of your capital intact. Your confidence stays strong. Your decision-making stays clear. You're still in the game. Here's your new rule, and it's absolute. If your position size makes you check your screen every 2 minutes, it's too big. Cut it in half, then cut it in half again. This isn't hyperbole. Most traders need to reduce their position size by 75% before they reach the point where they can actually hold a trade without emotional interference. That feels absurd when you first hear it. You think, if I cut my size that much, I'll barely make any money. But that reaction proves you don't understand the game yet. You should be able to walk away from your screen for 10 or 15 minutes without feeling like your world might end while you're gone. If you can't, your size isn't aligned with your psychology. If you feel physical tightness in your chest when the stock ticks down, it's too big. If you're praying, it's too big. The amateur size is for maximum profit. If I'm right, I want to make as much as possible. They calculate the upside. They dream about the gains. They size for excitement. The professional size is for maximum patience. I want to hold this position comfortably until my target is hit, no matter what the stock does along the way. They prioritize emotional control over short-term profit. And emotional control is what separates long-term winners from everyone else. When you size correctly, something magical happens. You stop watching every tick. You stop second-guessing your entry. You stop moving your stop-loss because you're scared. You trust your plan. You realize that volatility is just the price of admission, the tax you pay to ride the trend. Large positions make that tax unaffordable. Small positions make it negligible. The goal isn't to make a fortune on one trade. That's lottery ticket mentality. The goal is to stay in the game long enough to let probability work in your favor across hundreds of trades. You want to be able to take 10 losses in a row and still have your capital and confidence intact. Professionals win not because they risk more per trade, but because they risk less. They survive the inevitable losing streaks that destroy over-leveraged amateurs. They're still trading when the big moves arrive. They compound wealth because they size for patience, not greed. In the next chapter, I'll show you how to set that stop-loss, not as a safety net you hope never gets hit, but as your license to be patient without fear. A stop-loss isn't just a safety net, it's your permission slip to be patient. Without a properly placed stop, every small dip feels like a direct attack on your capital, your competence, your future. With a smart stop, every dip becomes just noise in the background while you wait for your target. The difference between these two experiences isn't about the stock's behavior. It's about the placement of one simple order that either liberates you or imprisons you. Here's how amateurs destroy themselves with stops. They set them too tight, desperately trying to avoid any pain at all. Picture this scenario. You buy at $47.30 after waiting patiently for all 3 confirmation signals. You feel good about the trade. The setup is clean. The volume is there. The market is cooperating. But the moment you enter, fear creeps in. You think, what if I'm wrong? What if it drops? So you immediately place a stop at $47.15, just 15 cents below your entry. It feels safe. It feels responsible. You tell yourself you're being disciplined. Then the stock does what stocks always do. It breathes. It dips to $47.20, then $47.18, then $47.12. Your stop gets triggered. You're out with an 18-cent loss. You feel relieved for about 30 seconds. At least you protected your capital. Then you watch in agony as the stock bounces back to $47.25. then $47.50, then $48, then $48.80. The move you identified, the move you waited for, the move you entered, it happened exactly as you predicted. But you weren't in it. You got shaken out by normal volatility because your stop was placed based on fear, not logic. You protected yourself from an 18-cent loss and missed a $1.50 winner. That's not risk management. That's self-sabotage disguised as discipline. You were betting that your timing was perfect to the penny, demanding that the market move in your favor immediately without any fluctuation. That's an arrogant bet. The market doesn't care about your entry price or your comfort zone. The professional approach is completely different. It's built on logic, not emotion. Professionals study the stock's natural volatility before they ever place a trade. Every stock has its own heartbeat, an average range it moves during normal market hours. Some stocks are calm and move 20 cents an hour. Others are wild and swing $1 in 15 minutes. You cannot trade a volatile tech stock with the same stop loss you use for a slow utility stock. You can measure this scientifically. Look at the average true range indicator set to 14 periods, or simply examine the last 10 to 20 candles on your time frame. What's the average distance between the highs and lows? If the adder shows 35 cents, you know this stock regularly moves 35 cents as part of its normal rhythm. Setting a stop 15 cents away from your entry is asking to be shaken out by routine market breathing. Once professionals understand the stock's normal breathing room, they set the stop just beyond that range. If a stock typically swings 40 cents intraday, they give it 50 cents of room. Not 30 cents, not 20, 50. Why? Because they want to be stopped out only if their trade thesis is actually wrong, not because the stock took a normal breath. Let's apply this to our $47 breakout trade with precision. You enter at $47.30 after all three signals confirm. Before you even clicked buy, you already studied this stock's recent price action. You calculated that over the last week, during normal trading hours, this stock moves an average of 35 cents per hour. That's its natural volatility. That's how much space it needs to move without signaling that something is broken. So you set your stop at $46.70, 60 cents below your entry. This number isn't random. It gives the stock almost double its normal hourly range. It's below the consolidation zone, below the pivotal point, outside the noise. If the stock hits $46.70, something fundamental has changed. The breakout has genuinely failed. The buyers who were supposed to show up didn't. The move is dead. At that point, you exit without hesitation or negotiation. That's a stop-loss functioning as it should. A pre-made decision, written when you were calm, protecting you from the emotional chaos of the moment. But here's the power of this approach. If the stock dips to $47.05, you don't flinch. Your stop is 65 cents away. If it dips to 46.95 cents, you still don't flinch. Your stop is still 25 cents away. You have room. You can breathe. You can wait for the move to develop. This is the magic of a properly placed stop. It removes the emotional burden of watching every tick. You're not sitting there thinking, should I get out? Is this dip normal, or is this the start of something worse? You already decided. The uncertainty is gone. You know your maximum loss. You've accepted it in advance. Now you're free to let the trade work without constantly second-guessing your entry. This connects directly back to position sizing. You don't pick a random dollar stop and hope it fits your risk plan. You start with your risk amount, say 1% of your account, and work backward. The stop goes where the trade is wrong, and the size adjusts to fit the risk. You adjust your share count to match the stop, not the other way around. If the stop needs to be wide, you buy fewer shares. Your dollar risk stays the same, but your staying power increases dramatically. Here's the maxim that will save your account. A tight stop protects your capital, but kills your patience. A smart stop protects both. The goal isn't to avoid all losses. That's impossible. The goal is to avoid big losses while giving your winners room to develop. Professionals lose small and win big. Amateurs cut winners short and let losers run. The difference is in the stop placement and the discipline to honor it without negotiation. When you have a smart stop, a stop out isn't a failure, It's a business expense. It's the overhead cost of running a trading business. When you accept that, the fear disappears. And when the fear disappears, patience is the only thing left. In our final chapter, you'll see how this entire framework, patience, confirmation, sizing, and stops, transforms from a single trade tactic into a sustainable trading lifestyle that compounds wealth over time. One trade, 1 hour, $500. That's the story we started with, and it sounds seductive. It sounds like easy money, like a magic trick you can pull out whenever you need cash. But here's the deeper truth that will determine whether you're still trading profitably 5 years from now. That $500 didn't come from 1 hour of work. It came from becoming the type of person who can wait 67 minutes without clicking a button when their brain is screaming at them to do something. Anything. Patience isn't a technique you apply when you remember. It's not a tool you pull out of your trading toolkit on days when you feel disciplined. Patience is something you become. It's an identity. It's a lifestyle that separates the small minority of consistently profitable traders from the 92% who eventually blow up their accounts and disappear from the markets. The amateur treats patience like a jacket they can put on and take off. They're disciplined on Monday when they're fresh and motivated. They wait for the perfect setup, they execute our 3-signal framework flawlessly, and they win. But Tuesday feels slow, so they force a trade that only meets 2 out of 3 criteria. Wednesday they're bored, so they chase a breakout without proper volume confirmation. Thursday they're behind for the week, so they size too big trying to catch up. By Friday, they've given back Monday's gains plus interest. This inconsistency is exactly why they never break through to sustainable profitability. You cannot be a professional trader 3 days a week and a gambler the other 2. The market will find your weakest moment, your most impatient hour, and it will take back everything you made during your disciplined periods. The professional operates from a completely different identity. They don't wait for 1 trade. They wait for 10. They wait for 100. They sit through entire sessions where nothing meets their 3-signal criteria, and they're completely comfortable with that outcome. They watch dozens of stocks break through our pivotal points and refuse to enter because volume isn't expanding or the broader market is showing weakness. They go days without trading, and instead of feeling anxious about missing opportunities, they feel proud of their discipline. Why? Because they've internalized the fundamental truth that changes everything about how you approach markets. Waiting is a position. When you hold cash, you're not sitting on the sidelines missing the game. You are actively positioned in the safest asset available, preserving capital and mental clarity for the exact moment when all variables align in your favor. Cash is a position. Waiting is work. The professional gets paid for the discipline of doing nothing when nothing should be done. Let me show you what this looks like over time with precise numbers, because that's where the real separation between amateur and professional becomes mathematically undeniable. In 1 month, the professional takes 5 trades. Not 50. 5. Each one meets all 3 confirmation signals we discussed. Price holding above the pivotal point for 30 minutes. Volume remaining elevated and expanding, and the broader market cooperating. Each trade is sized for maximum patience, using 1 to 2% risk. Each trade has a properly placed stop that respects the stock's natural volatility. They execute their plan without deviation. No emotional adjustments. No mid-trade negotiations with themselves. Out of those 5 trades, they win on 3 and lose on 2. A 60% win rate, which sounds modest but misses the point entirely. What matters is the reward-to-risk ratio. Because they were selective and patient, their winners had room to run. Their average winner is $650. Their average loser, kept small by smart stop placement, is $180. The math: 3 wins at $650 each equals $950 in gross profit. 2 losses at $180 each equals $360 in gross loss. Net profit for the month, $1,590 on 5 carefully selected trades. Their reward-to-risk ratio is 3.6 to 1, meaning they make 360 cents for every dollar they risk. This asymmetry is where sustainable wealth comes from. Now examine the amateur's month. Same market, same opportunities available. Same stocks breaking through the same pivotal points. The amateur takes 50 trades. They can't sit still. They chase every breakout that looks strong, even without volume confirmation. They short stocks just because they've run up, ignoring our three-signal framework. They try to scalp the lunch hour chop. They size too big on setups they're super confident about and too small on textbook patterns because those feel too obvious. They win on 28 trades and lose on 22. On paper, that's a 56% win rate with more total winning trades than the professional. But here's where the mathematics of impatience destroys them. Because they're trading noise instead of signal, because they're cutting winners early and holding losers too long, their average winner is only $180. Their average loser balloons to $290 as they hope and hold instead of honoring their stops. The math: 28 wins at $180 each equals $5,040 in gross profit. 22 losses at $290 each equals $6,380 in gross loss. Net result: negative $1,340 on 50 frantic trades. Same month, same market conditions. The professional made $1,590 by trading 5 times. The amateur lost $1,340 by trading 50 times. That's a $2,930 performance gap, created not by superior market knowledge or secret indicators, but by patience. The professional traded less and made more. The amateur worked 10 times harder to lose money. This pattern compounds over time. The professional preserves capital and emotional energy for high probability setups. The amateur bleeds both through the cumulative damage of taking mediocre trades. After 6 months, the gap becomes a chasm. After a year, it becomes life-changing. Your transformation from amateur to professional starts with building the patience muscle deliberately, the same way you'd build physical strength through repetition. Here's your assignment for this week. Take one trade, just one. You're going to sit at your screen and watch setups form that don't quite meet all 3 criteria. You're going to feel the itch to enter early, to chase, to force action. You're going to physically remove your hands from the keyboard and wait. You wait until you see our $47.20 scenario play out perfectly. Price breaks and holds above the pivotal point for 30 minutes. Volume expands and stays elevated, and the broader market cooperates. All 3 signals green. No exceptions. No close enough. Size that trade for comfort, not profit maximization. Use 1% risk, not 3. Make the position small enough that normal volatility feels like background noise, not a threat to your survival. Set your stop where the trade thesis is actually wrong, beyond the stock's normal breathing room, not where your fear gets loud. Honor that stop without negotiation if it gets hit. When you hit your target, walk away. Don't immediately hunt for the next setup. Close your platform. Go for a walk. Let the wind settle. This is how you train your brain to associate patience with profit instead of anxiety. Do this consistently, and something will shift in your identity. You'll stop feeling restless when you're flat. You'll start feeling uncomfortable when you consider taking a trade that doesn't meet all your criteria. The discomfort will flip. That's when you know you're becoming a professional. You'll discover what every consistently profitable trader knows: the market pays you for the trades you don't take as much as the ones you do. Every mediocre setup you pass preserves your capital for the setups that actually matter. Every bad trade you avoid is money saved and emotional energy preserved. The amateur thinks the goal is to trade more. The professional knows the goal is to trade better, and trading better almost always means trading less. One trade, 1 hour, $500. That's not fantasy. That's what happens when you build your entire approach around patience, confirmation, proper sizing, and smart stops. That's what happens when you stop trying to be busy and start trying to be right. The market will always be here tomorrow. Your capital and your emotional stability might not be if you don't master this discipline today.